All right, what's going on, everyone? Today we're going to be talking about straddles versus strangles for earnings events, and we're also going to be talking about trading monthly contracts, so maybe like 20 days out sometimes. But when the premium is really low, it's something that I've sort of seen over the last couple days that I want to bring up with you all. But to kick things off, let's do a recap of how earnings is doing, and also it's Friday. We'll talk about how the ETF strategy is doing. So first, earnings. It was a little bit sketchy overnight. I really thought we were going to get clapped today, which is it's going to happen eventually. But today we dodged the bullet, and so Skechers and WDC were the ones that were looking a little bit sketchy overnight. You know, it was like a 7% implied move for both of those trades, and overnight they had each moved like 12%. I was like, geez, we're gonna take a hit here. But obviously it happens. I still slept like a baby. But this morning, Skechers opened up literally flat. So it ended up being a huge winner. And WDC, I was in this pretty wide strangle, so it came down to like an 8% move, and that kept it within the body of my strangle. I ended up getting a profit there, which is really cool. And funny enough, WY and CRI ended up being losers, which was just like kind of ironic. Overall, we were up on the day, which was pretty cool. I'm really enjoying doing this, strangle approach. I think it makes a lot of sense, and we'll talk about that in a second here. But there are definitely trade-offs to doing it. Now, before we move on to anything else, I want to do a recap of the ETF strategy. So I have a confession to make. I have not done a good job of tracking it. So I'll show you the journal here. These are the trades that I have open right now. It's the long and short position from the ETF premium strategy. So I'm in 4 trades really. But if you look at the journal, the last time I actually tracked something was in July. So I've kind of sucked at it. If any of the PA members watching this have done a good job of tracking this, I am trying to put together some evidence, a case study similar to what we did with Jay for the ETFs, because I know it's been going pretty well. I just didn't document it because, I don't know, I'm dumb. But if you have good documentation of it, please let me know. I'd love to do a little collab, and we can make something to help the community. But yeah, so today's trades are actually going really well. Just for this week, I guess we'll show the account, and so this is what we're trading together here, and you can see we're in EWZ right here, and then if we scroll down, here's the 3 others that we're in. Basically, all of them are doing all right. We're making our return more or less on all of them. I think they're all still all the positions are out of the money. Some of them are slightly in the money. We'll see how it looks towards the end of the day. I don't close these out until the end of the day, which is why these all still say pending. I'm in my 3rd or 4th cycle for most of them, right? So if you remember from the strategy, the idea is you hold one long strangle hedge, and then you're rolling a bunch of weeklies underneath it. That's kind of the way that we're monetizing the risk premium. And they're all pretty much just picked from the, if we just go into the scanner here, they're all pretty much just from this here, the ETF premium scan. Well, my computer's lagging a bit, but hopefully it will cooperate with us. So yeah, that's where we're at with the ETF one. It's been going well. I wish I didn't get lazy and I actually documented it, but yeah, things are good. So both strategies looking really great. Earnings season's off to a good start. I'm happy about that. ETF strategy going well. So what do I want to talk about now? I want to talk about straddles versus strangles. Let's get into that. Honestly, up until I did this case study with Jay, I kind of stopped entertaining the idea of doing strangles around earnings events for the most part. Because the idea is the straddle is the implied move. Something that I thought was making a lot of sense at the time was, you want to trade the thing that gives you the exact implied move because it gives you the most feedback about if the implied versus average move is actually, playing out the way you think it should. But then I started to think about it a little bit more. This earnings effect has been around for decades. Maybe it'll come and go a bit, but generally speaking, I think it makes sense that earnings should have a premium over time, even if it goes through a period where it doesn't. So I'm going to kind of operate on the assumption that the earnings risk premium exists. And so I don't need that direct feedback because this isn't a new edge that I'm trying to monetize. So the question really becomes, where is vol the most expensive? And I think, with earnings, it's who's buying at the money, who's buying out of the money. And I think out of the money makes a lot of sense. Like if you're buying a lottery ticket, you're probably going to buy something out of the money. And if you're buying like serious downside protection, you're probably going a little bit out of the money too. Kind of like what we talked about in this here. This is for the ETF strategy, but I think it still applies. So like short dated contracts with, slightly out of the money strikes, that seems to have the highest risk premium. So I feel like that makes sense. And for that reason, I think there is a good case to be made for trading these strangles around earnings. The only causes for concern I have there is two things. One is liquidity, and number two is like your drawdowns can really get out of hand if you screw up your leverage. So I haven't quite got it all figured out yet. I'm leaning on Jay's case study a little bit there. Jay's quite the cowboy, though. He's definitely got a little more leverage packed on than I would, but I think there's a good lesson there for all of us. So I've been playing around with these strangles more, as you see with the case study here, right? Or the trades that I'm tracking. It's basically all strangles right now, and it has been working out in my favor, right? The extra width has definitely been helping. I've been seeing a profit more often, but I haven't gotten clapped yet, so we don't know what that's going to look like. I'm just hoping that these massive drawdowns that eventually come will be outweighed by the little premiums I'm collecting over time, and that's why I keep trying to take like 3 or 4 trades a day at least, just to keep that volume of trades up, get some diversification, and we'll see what happens. All right, second topic that I want to chat with y'all about is trading the monthlies, like these November contracts here. The one that I want to look at in particular is this one, WY. So WY, I had a pretty decent implied move. It had a really good back test. We can try and pull it up here. Let's come over here, go to WY. All right, so it had like, whatever, like a 4% implied move, 2% move here. The stock moved, like not even a percent. It was like perfect. I should have made a lot of money on this, but I don't know how to put this exactly, but I ended up not even being able to close out for a profit, and maybe I got a little greedy or a little rushed. Should have waited a little bit, but like I'm trying to think about it, and this thing's trading for 30 cents. And there's still, 20 days of non-event vol remaining. Like, what was this really going to go down to? Like maybe like 25 cents, 23 cents. So if that's the case, and then I'm paying, a buck or two on each side to get in and out of this trade for a one lot, it's like I have like maybe 4 cents of edge here. And it just didn't make sense. So I think I'm going to stop taking these trades unless the expiration is like tomorrow. I think trading something that has, 30 cents of premium can make sense if you're basically expiring tomorrow or maybe in like a couple days. But I don't think it makes sense when there's the 20 days left or whatever. If there's like $2 or $3 of premium, then I think it can make sense because you have like 40, 50 cents of edge maybe. And then, you're, assuming it's liquid enough because it's a monthly, yada, yada, it can work out pretty good. So that's where I'm kind of at with it. I don't think I'll be doing trades like WY anymore. CRI is an example of one that I would do. I think I got a little unlucky with this one. It did open up flat this morning, and then it just got like absolutely smoked. Went down like 6% after the open, before vol had settled, really, before the spread had really come in, so I could exit. A little bit unlucky. So when I saw that happening, I kind of just got out quick, took a small loss. No big deal. All was good. So as for what I'm going to be doing today, I don't know if there's any earnings trades that are happening today that happen over the weekend. I typically don't take those. So no earnings today. No panic after market for me. Instead, I'll just be rolling my ETF positions. So I will be pretty much rolling into the same ones. I might take a look, maybe add one more. There's some other good ones on there. Like DIA is one that I think that is really nice, but it's a pretty big ticker. I'm using most of the margin for earnings right now, so I don't think I'll be going into a trade like that. I'm pretty happy with the 4 that I have, and I'll just be leaving that, right? in the end of the day, I spend maybe like 20 minutes a week on this strategy. Um, it's actually one of the things I like about it. I don't want to be spending all day on this strategy. So that's pretty cool. I think that's everything I wanted to cover in this video. If y'all have any questions, feel free to leave a comment. I've been hearing really good feedback about the case study from Jay. So if you guys want to see some more stuff like that, I can reach out to the community, see what people are doing. We've got this one that we're building together live. When this gets up to, a couple hundred trades maybe, or at the end of the season, we'll put something out there potentially. So, yeah. All right, everyone. Have a good weekend and happy trading. We'll chat soon.